Welcome to Investors Insights. Our topic today is, it's going to cost you. We chose that topic because our questions from our clients are in relation to inflation, market volatility, bond yields, and we think we've got a great perspective to share with you today. I'm honored to have with me Bobby Norman, Trey Booth, and Ty Miller with me to have that conversation and bring all this together for you. And we're going to continue the conversation throughout the week on LinkedIn, Twitter, Facebook, and also on our podcast. To start off with, let me say something here, Trey. The phone calls, the Zoom meetings, and in-person meetings we're having, everybody's been like, look, this market has traded down some. We had a great year last year. Are we looking at some kind of big drop, and should I be anxious? Talk about that.
Yeah, absolutely, Greg. I mean, volatility is just a part of the market. You're going to see pullbacks for sure. It's when those pullbacks occur that we think is important, and we found some interesting data to support that the importance of the win. So since 1945, there have been a total of 61 pullbacks of 5 to 10%, and 23 corrections of between 10 and 20% in the stock market. Of those pullbacks, the ones that started before the end of February, 100% of the time, the market ended higher by the end of the year. And so
that's a fascinating,
not just higher from the low, but they fully recovered any losses. So if you never want to see the market down, but if it's going to be down, you want it early. So let's just go ahead and get it out of the way. And so the later in the year it goes, the more costly it is to you. If the correction starts in June, you only have a 63% chance of recovering.
I thoroughly enjoyed that information when you shared it in our portfolio strategies meeting. So for those of you that are a little worried about the volatility in the market here, should we have a pullback, here is some great information for you to understand the impact it could have on your portfolio, depending on when it happens in the year. Now, why the volatility all of a sudden out of nowhere that's really picked up? And Bobby, last week, we talked about inflation. And inflation is the reason we picked the topic today. It's going to cost you. So talk to us about that and the impact inflation's having today and what we're seeing going forward.
Yeah, Greg, we've been talking about inflation for months now. And last week we saw inflation hit the highest year-over-year spike in over 40 years. And after being relatively stable, around 2% for the past 25 years, inflation has erupted from virtually every corner of our economy. So 7% was the number last week. That's a big number, 7% spike. And so as we continue in the new year, inflation poses one of, if not the single biggest challenge to the economy, investors, and then especially policymakers. And that is why we continue to highlight it in our weekly conversations. And speaking of conversations, I had a conversation with a client last week, and she was asking about what exactly is the cause of this record inflation. So I want to share this chart that shows what exactly is contributing to the spike. On the right-hand side, the light blue represents energy. Energy has more than doubled year over year. The light gray at the bottom shows the increase in the cost of food, which if you've been to the grocery store recently, you've probably noticed your bill is higher. I know I have.
Yeah, and same here.
Yeah, and look at the black section, which represents the increase in cost of durable goods. Durable goods are cars, refrigerators, dishwashers, washer dryers, more big ticket items. And the last area I want to highlight is the orange area, which is rent and housing. And rent and housing has remained a big driver of higher inflation the past few years. But the bottom line is this: we could see inflation get worse before it gets better as supply chain issues get worked out. And the bottom line is that the market will be greatly impacted by how aggressive the Federal Reserve deals with inflation. And that is something we're analyzing very carefully. That's why we'll continue to talk about it, probably on a weekly basis. It's that important. So watch inflation carefully.
Well, and with the points you're making, I also want to say to our viewers that last week, Ashley Page did a great vlog on the experience economy and the amount of revenue that should be generated from that. Now, the reason I'm bringing this up, because all our information ties together information that we're watching. But Trey, with that blog, you brought up the fact, and in this conversation debate with Bobby, that service is not causing the inflation, correct? You want to elaborate?
Yeah, absolutely. Over the last few years, we've seen an explosion in demand for goods, those durable goods or in non-durable goods. The individual consumers are spending a lot of money on goods and less on services, the experiences, the going out to eat. Goods are very inflationary because they require goods need to be shipped, goods need to be sold at a store, goods need to be produced using typically input commodities. Very inflationary. But we've seen expansion in services. That's not nearly as inflationary because services can be multiplied, can be duplicated, and any service inflation goes straight to increase in wages, which on a total economy is still net positive.
Yeah. So I want to challenge our viewers to watch Ashley Page's vlog. If you haven't already watched it, watch it from last week. It's excellent. Also watch our blog from last week as we started lining up and talking about inflation and the impact. And then going over here to Ty Miller. Ty, you brought in information from last week, but in terms of bond yields, interest rates, that has people concerned in relation to the inflation that we're experiencing. So elaborate on that.
Yeah. So to begin the year here, bond yields have kind of skyrocketed compared to what they were. Just keep in mind that they were at very low levels to begin with. And that has some people worried about what's in store for stock prices, because typically bonds, if the yields go higher, that provides some competition for stocks. But it's important to keep in mind that yields only rise when the economy is good. It's what it typically means.
True.
And actually, in the last 6 times, what we saw is that when bond yields, specifically the 10-year Treasury, have a substantial gain that lasts, then stock market performance has been rather remarkable, as you can see in this chart. Last 6 times, it's been a gain and rather substantial.
That's good. So, folks, we've covered volatility. We've covered the unexpected downturn should we trade back here before the end of February. We've talked about it's going to cost you in terms of inflation. It's out there, and we're looking and trying to determine how long it's going to last. And if interest rates go up, that shows and confirms the economy is doing well, and you should see some returns out there that you may like. With that said, we appreciate you taking time not only to watch these vlogs, but to share them with others. We get great response, and it's because of you. And we appreciate the trust that you've placed in us. We are honored to be your family office. And we also want you to know that every day we strive to help you have a better, richer, fuller life. Have a great rest of the week. We thank you. Talk soon.